All right. Welcome everyone to today's virtual seminar in the SAMF, Social Matching in Macro and Finance series. So this is already our last talk of the term. We're very happy to have Saki Bigio today. We're also soon going to announce the spring schedule, so stay tuned. In a few weeks, we were planning to send out an email with the next talks, but today it's all about Saki and his paper Portfolio Theory with Settlement Frictions, joined with Javier Bianchi. So, Saki, the floor is yours.
All right. Well, thank you so much, Lucas and Bruno, for inviting me and for managing this great public good. And thank you for all the discussants that agreed to show up. Yeah, we were very intimidated when we saw the list. So thank you all. So this is joint with Javier Bianchi, and the standard disclaimer that the views in this paper don't represent the views of the Federal Reserve applies to this paper as well. All right. So the starting point of our paper is the following observation. If you look into a lot of recent empirical macro finance papers, many of them emphasize the role of convenience yields, understood as premia that are otherwise unexplained by cash flows, even if risk adjusted. And we find evidence of such convenience yields, say, for example, in the loan market, in the corporate versus treasury market, when you look at super safe assets of same maturity, you find spreads that are hard to explain with risk premia. Likewise, you find a spread between the treasury market and reserves, and you also find convenience yield showing up in exchange rate markets when you look at things like CIP deviations, for example. But often, this empirical literature takes these convenience yields as exogenous. And what we do in this agenda, this paper is part of a broader agenda that Javier and I started and now involves other papers, is to link convenience yields to this idea of settlement risk. And settlement risk is something I'm going to explain in a second, but it's related to the fact that portfolios, positions induce the need to have a settlement asset, and that settlement asset is traded in an over-the-counter market. So one question we should always ask is, why do we need more micro foundations? We don't want to do micro foundations for the sake of micro foundations. What we do in this paper is we teach you as well how to link the predictions in this model to observables for the market for settlement instruments, whatever that market is. So things like the over the counter volume, the rates, the rate dispersion, and the convenience yield themselves. We show you how to map those into those objects, and so that's one of the contributions. And the second one is the Lucas critique. The convenience yield often respond to policy. Many papers in the past have emphasized that if you look at convenience yield and monetary moves these convenience yields, like why should these be exogenous? So the main idea in this agenda follows an earlier spirit of a model by Poole. And it's the idea that investors form portfolios, and some of those portfolios may move very quickly in the short run. So, for example, if you hold assets, you can hold assets as much as you want. But if you issue deposits, or if you issue credit lines, or if you have margin calls, these assets may trigger movements in the portfolio. And that may induce the need to find short-term cash to settle the position. So for example, if you fund a portfolio of loans with deposits may leave the bank. And if they leave your bank, you cannot sell your loans quickly. You have to use a certain settlement instrument as an instrument to settle the movement of liabilities across banks. The same thing with margin calls. If you issue or credit lines, if you issue a credit line to a borrower, the day the borrower makes use of the credit line, you have to use reserves to settle the transfers. And that risk, the risk of being short or long of reserves, induces the possibility of having a cash deficit and a cash surplus. So in particular, financial institutions, investors that have a deficit position have to find cash in the short term, and that market, the market for lending and borrowing cash instruments, may become frictional, and as a result, the portfolios will inherit the frictions of this over-the-counter market. And what we find is that under specific assumptions that we're going to do in this paper is that you can think of these risks as something that you attach to a portfolio in a way that enters as a kink function. So let me explain what I refer to as this kink function in a graph. So in addition to the standard way in which you form a portfolio, that is, buying assets and liabilities and having risk in the return of the assets, what we think is an important dimension is the idea that given a portfolio, a specific portfolio, there will be a distribution of outcomes unrelated to the payoffs of the assets. It's related to the position regarding the cash that you have to settle in a particular moment or date. And if you're in a positive position, you will end up with a particular payoff associated with the cash and a particular different payoff associated with a negative cash position. That's what we refer to this as to this kink function. And this kink function is associated with frictions in the OTC market. If you didn't have frictions, there wouldn't be a kink in this function. So the paper is going to describe how we get into that kink function. Portfolios that have more cash or portfolios that shift toward assets that are less have less liquidity risk. For example, you have long-term deposits, will shift this distribution to the right or to the left. So, riskier portfolios are associated with portfolios where the chances that you end up with a cash deficit are higher. So how do we get to this kink function? What is it exactly that we do here? So in some sense, the over-the-counter market is off the shelf. It's taken directly from Ricardo Lagos and Garafonso's work. And we're not going to be specific about whether this is a federal funds market or an international market to settle international positions in the case of exchange rate markets, or if you think of the financial sector using commercial bank deposits as a settlement instrument. We can think of markets for short-term funding for other institutions that are not necessarily the federal funds market, which is the focus of Ricardo. So the OTC market is directly taken from Ricardo and Gara's work. But we're going to make some assumptions on small traders, borrow from elsewhere in the literature, and we're going to take a continuous time approximation. And what we're going to find is that this kink function represents the average cost of an agent that has a deficit of finding cash in the market, or a guy that has a surplus, the average benefit of lending cash in this over-the-counter market. These slopes of these yield functions are going to be functions of the market tightness. How much cash deficits, S minus, is or demanded relative to the surplus of cash in the market. And it's going to depend on the matching function. It's going to depend on an efficiency parameter. It's going to depend on Nash bargaining power. And we can link these parameters to observables such as the OTC rate, volumes, and dispersion. And then we embed this kink function into a standard penalty, or this kink function that enters as a penalty into our standard portfolio, and derive convenience yields across assets. And we describe also the efficiency properties in this market, whether investors as a whole are holding excess cash or have a cash deficit. So that's what we do in the paper.
Saki,
Yes.
to get into, since you're talking about microfoundation, I'm curious what you have in mind in terms of the underlying friction causing these search frictions in this market. Do you think about this like a technology friction? We just don't have better technologies to interact with each other? Other than doing it in the OTC market, or are there information asymmetries, bargaining power, et cetera, and then how?
It's a great question. So we should ask why is the market for settlements over the counter? And I think a natural way to think about this market as being over the counter is for the reason that this is a market for credit. When somebody's in deficit, he needs to borrow cash. So whenever I think of credit markets, this is not a non-standardized product. It's not like I'm buying grain or oil, and so a Eurasian market makes a lot of sense. I have counterparty risk. So that's why I think it has to be over the counter. So it's a bilateral market. And then the question is, why can counterparties willing to lend to each other find each other immediately? Well, the moment it's bilateral, you need to be lucky and find a contract with somebody that is willing to lend to you, but actually has a cash surplus, and that's associated with information frictions and the actual technology. So that's what we have in mind.
I see, but a counterparty risk, you can have a centralized market with counterparty risk.
I guess you can, but I think we want to think of also the possibility that the guys that are willing to lend, I don't know exactly who they are, and you could have a centralized platform, but for many
You're not
instances
sure who said
we
that,
don't have we
Saki?
don't have. Say again?
Saki?
Yes.
You can't have you can't have a Eurasian market with counterparty risk. It's impossible. In Eurasian markets, you don't trade bilaterally, so you don't have a
But
counterparty.
no, but the risk that somebody doesn't pay, you can settle centrally,
In
right?
Eurasian markets, you don't trade with other
I'm not
individuals.
saying
You trade along
Eurasian
your
per se.
budget line. What do you mean by
Okay.
centralized then?
So clearly, this is not settled in the literature. So let me explain what we're doing here. But I have that motivation. And maybe it's the wrong motivation, Christian. Uh,
No, I'm
Maybe
not saying it's the
Randy's
wrong
right and it's the
motivation. I
right
was just trying
motivation.
to poke a little bit
Let's take it at face
to
value
understand
and
it.
leave it for the discussion at the end because it's a deep question we cannot answer in this paper. But
Saki,
what
can
we
I
want
ask
you
a
to think
quick
about
one?
in the paper is that
Saki,
yes,
can I ask a quick one also?
yes.
It's Thanasis here. Hi.
Hey, Thanasis.
So when you go back to Krishnamurthy and Vincent Jorgensen, I think they use convenience yield under the umbrella of convenience yield. They put the liquidity and the safety premium. For today, should I think more liquidity premium, right? Because I know you want to link
I
to.
mean, the thing is, I don't know what they refer to as safety premium. I mean, I need a definition to know
Yeah.
exactly what people think when
Yeah.
they're
Sometimes,
talking.
macro and finance, they talk slightly different language, and I just want to
Yeah.
clarify
So
what we're talking
so
about
so
today.
for now, I want you to
Liquidity,
think
right?
about convenience yields. If you want to think of the empirics just as some premium that you would have on otherwise identical cash flows.
And that doesn't come from the
In the context
dividends.
of the model, I want you to think of just something associated with scarcity
Well, I
of
like
cash
to think of
market
it like
coupled
I
with
think of the soul. Saki, you think of the soul residual. It's a measure of our ignorance. You look at
yes,
capital labor output, there's something left over. We call that the solar residual. This
yes,
convenience yield, you look at portfolios, prices. If the curve don't fit, you call the residual convenience yield. And it's again a measure of our ignorance.
yes, and
Hopefully, you're going to try to microfound it a bit more than saying it's merely a residual.
yes, and for example, here we're going to show you that it matters for efficiency, for example.
Of course.
All right, so um,
Okay,
we're going
Actually,
to
that's
show
an
you
excellent point
basically
you made.
how. Say again.
It's an excellent point. If you want to do welfare economics, unless you put convenience in the welfare function, you can't do it.
Yes.
So that's an excellent point. You need micro foundations to do welfare in addition to your other motivations.
Yes. Yeah, and then another value of having micro foundations that you can map them to actual micro data.
Right.
And part of the talk is to tell you how to match parameters to objects that we observe in the data and what parameters are bad for or which data is bad for making inference about other parameters. So some data is useful, for example, to obtain efficiency. Some other data is not. So convenience yields don't match one-to-one to efficiency. I'm going to show you that. Okay, so to that point,
Saki, can I ask a question about the
yes,
micro
just a sec.
foundation of the
Just I want to
kink?
just explain what this picture does. To that point, we're going to show you basically how different objects in the environment, the market tightness or the parameters of the OTC model map into how these kinks move, and how these kinks move tell us something about how premia move. Okay.
Yeah, I guess I have a related question. So what determines the kink and how kink moves? In Afonso Lagos, it's clearer because there the kink is related to the required reserve requirement. But for a bank, maybe they are subject to other requirements like capital requirement.
No, this
liquidity
has
coverage
nothing to do
ratio?
with capital requirements.
Mm.
The kink is the zero that or the position of the kink depends on what is determining your whether you're short of cash or not. So if you put
Usually
more
when the
reserve
Lagrange
requirements,
multiplier hits
you
zero, right?
say again.
It's when the Lagrange multiplier on the liquidity constraint hits zero. That's where
Yes,
the kick comes in.
yes, yes. And so if you were to in the x-axis instead of plotting the surplus, you were plotting the cash position. Reserve requirements move the location of the kink. But more importantly for us is the idea that how these slopes move. So what's in this picture? How this orange line vis-a-vis the red line move. So what makes this function more concave as if you widen up the slopes. So that's the point. Okay.
There's a related question in the audience, I mean, in the chat window, which is like, does the kink depend on the riskiness of
So
the bank's
I'm
yeah.
gonna talk about all of
Okay.
that. So
Yeah.
I'm
Okay.
one fourth on my into my talk. Okay. Um, there's many papers that have been using the solutions in this model as inputs for models to study monetary policy. We've also done some works for exchange rate. Here we have some lessons regarding efficiency and how to calibrate the model. There's a vast literature talking about liquidity premia giving rise to convenience yield. What do these papers do? Many people in this audience have contributed to this literature, but so one area essentially looks at assets that have different properties as a medium of exchange. So, for example, if you can sell bonds to consume faster than you can sell money, or with a greater ease because they have less information problems, that's going to give rise to different convenience yields. So that's a different direction. That's a different tradition, if you want. So that's assets, properties regarding the assets as a medium of exchange. Here, what we say is no, assets are not good. Many assets are not good mediums of exchange. On the contrary, they expose you to settlement risk. So it's a different emphasis. We put it back in a portfolio problem. We show how it interacts with risk aversion. There's many other models now that have studied OTC markets with risk premia. Here, it's something where you form your portfolio. The returns of the portfolio will lead to losses or gains. If you're risk averse, that's going to covary with a settlement risk. So that we're going to show you where that's different. And then for OTC models, I mean, we have a closed form, which I think provides some insight and maybe useful to provide new insights for the literature. Okay, so this is how it works. It's an infinite horizon model. There's a unit mass of investors, and there's a general class of assets. Assets have their own return risk, and they're also associated with settlement risk. The settlement risk induces positions in the OTC market. It's a frictional OTC market. And as a result of the OTC frictions, if you're not able to borrow a cash deficit, you have to pay a penalty rate. Okay. So before I get into examples, the way it's going to work is there's two stages. So this is, something that, we're adapting from Lagos, right? These two-stage structure. But here you form first a portfolio. Once you form a portfolio of assets I, each asset I is associated with the possibility that a fraction of that asset induces a settlement position, a settlement shock. In the balancing stage, you cannot touch your assets. Every asset is illiquid in the sense of you cannot use it to settle, but you use a special asset, namely a specific asset called cash, to settle the position. And then if you're in deficit, you borrow from other investors the amount F, and if you're in surplus, you lend the amount F. And otherwise, if you're not able to borrow, if you're unlucky, you borrow the amount W. Okay. So as I said, assets differ in their payoffs and their liquidity properties. So AI can be any asset or liability. So if these are literally, think for example, deposits, these enter with a negative sign. So this is a negative asset in your budget constraint. If it's something like a credit line where I'm getting some return but the asset may leave and increase in size, you know, that enters as an asset. The special asset is M, which is riskless, and it's a special asset that we use for settlements. So we can think of M as in one scenario being reserves. In other scenarios, if you think of hedge funds, how do hedge funds settle movements in their portfolios? Well, they use, you know, bank money as a settlement instrument. They use bank deposits. So, you know, the real world is more complicated than how we show you in this model, which has multiple, you know, the real world has more layers. If you think of international payments, for example, you know, banks in Peru will settle movements of euro dollars to finance for, international trade with accounts in the US. And this is called like correspondent account transactions. So the budget constraint includes your current equity on the right-hand side, and you form your portfolio by allocating equity after paying dividends into holding some amount of cash and forming your portfolio of other assets, AI. So the constraint is that by the end of the period, after your movements in assets, in cash, you must always have a positive cash position. So why are these movements being generated? Each asset I, you start with a tilde position, like in this budget constraint in slide 11. But then in the balancing stage, a shock happens. And so if you have deposits, for example, this shock can represent that deposits leave your bank, or if you have a credit line, it means that, you know, you increase your assets, but that means that you have to decrease cash because you pay the you know, the owner of that credit line that's taking advantage of the credit line with cash. So the settlement position, the settlement surplus, is modified because you have M tilde at the beginning of the balancing stage, but the shock generates a movement that's in the settlement surplus line here. So it generates that inflow or outflow. The reason why you see a rate here is just so that the issuer of the asset pays the interest rate that he originally purchased. Okay, so let's put an example. So suppose you have an example of a credit line. So A is a positive number, and the outflow of the omega is 20%. So then that means that there's an increase in loans by 120. If the original cash position was 10, this guy enters in deficit. If it's a liability and the asset is actually negative, omega 0.3 means that this is an outflow of deposits. So deposits leave the bank. As a result, the deposit outflow, the liability outflow has to be settled. And it's a general setting so that it also leads to a negative cash position, regardless of whether it's an asset or a liability. Okay, so what takes or why is there OTC market for these assets and liability outflows? So the agent has to end up with a positive cash position, but before, you know, after the withdrawal or after the movement of the cash position, it has S. So it needs to borrow the remainder to end up positive. And it'll borrow F or omega or W. W is like the borrowings at that penalty rate. If the cash surplus is actually positive, F can be negative, meaning that it can lend out in the OTC market. It will turn out that in equilibrium of this OTC market, depending on how this market trades, there are going to be probabilities of borrowing and lending in the market. And these probabilities are endogenous, and they will determine the kink. So there's an overall final portfolio at the end of the period, considering the average rate in the OTC and the average amount borrowed at the penalty rate. These are average rates. The quantities traded depend on the probabilities. The penalty rates and the endogenous rate determines the payoffs of F and W. The key reason why we have a kink function is that these probabilities are actually different, and the outside options for the guy that doesn't find a counterparty to borrow is different from the outside option for the guy that doesn't have a lending opportunity. So taking advantage,
Saki,
yes,
sorry, just a
yes,
clarifying question
yes,
regarding the penalty rate. Could you talk a
yes,
bit more what you have in mind there? And
yes. So when you think of the domestic market, so for banks, a natural penalty rate is to think about the discount window. But it's not the only penalty rate that we have in markets for settlement instruments. So, for example, in international trade or international transactions, banks everywhere in the world are issuing deposits in dollars. And their lender of last resort is not the Fed. Their lender of last resort is US banks with whom they have pre-established credit lines. So just to give you one example, so Wachovia, which went under in 2008, was the main lender of last resort of Chilean banks in 2008. And when in 2008, Wachovia went under, um, the Chilean peso devalued by like X%. So that's telling us that those credit lines are meaningful. And so that's what we have in mind. It's not only the discount window of the Federal Reserve, but the financial system, depending on what asset is being used as settlement instruments, also creates these lenders of last resort.
I see.
It can
So
also
it's an
be
outside option basically relative to the OTC market.
it's an outside option relative to the OTC market. It can represent, for example, credit lines of banks on hedge funds. So it's loans, like in last minute loans on hedge funds, but these are pre-specified lines. So if you can't find a counterparty as a hedge fund to settle a negative position of assets, and you have in the repo market, you're not lucky, you can't find a counterpart, you use an expensive credit line from a bank. That's what we have in mind. Okay. So the key is that this kink function represents the average cost of borrowing when you're short of cash. So that's the average rate in the OTC market times the probability of borrowing in that market, and vice versa with borrowing from the outside option. And for the lender, it's the average probability of lending in the OTC market. If you put things together, if you stare at this rate of return on the portfolio the next period, you'll realize that after replacement, this object here becomes our kink function. Okay, and these slopes is an outcome of the OTC market, and that's what we're interested in. These depend on
Okay.
the yes,
The R bar F, so everyone
yes.
gets the same interest rate in that market. So this idea of OTC, who I
Okay,
find,
great question. So in this model, we're going to make assumptions so that there's a continuum of rates, but everyone gets the average. So that's where the large trader assumption and continuous time buys us, this property. So counterparty identities won't be present, but you will have many rates because this is a dynamic OTC market,
Okay.
like in Ricardo and Gara. Okay. All right. So
Saki, there's a question from Guido who says his microphone is not working. He says he'd
Okay.
likes to know how equilibrium changes if instead or on top of a penalty rate you had a fixed cost of accessing the fallback option. Do you have any thoughts on that?
If what? Sorry?
If you had a fixed cost of accessing the fallback option, I guess the W, instead of the penalty
Okay.
rate.
Yes. That's a great question. Let me postpone it for the discussion because I don't want to think about on top of my feet at this moment.
Okay.
That's a great question. I haven't thought about it. I thought about it if you have multiple penalty rates for different levels. So what that would do is just it would generate different splines instead of this kink, but it's a little bit more subtle than that. I'll explain why. Okay, so this is just off the bat Afonso Lago. So there are n trading rounds, and what we're gonna do is we're gonna split borrowers and lenders. So we're gonna take the mass of all the agents in deficit, sorry, and all the agents in surplus, and we're gonna split the market, and that market is gonna meet according to matching function G with efficiency indexed by the number of rounds. The reason why I'm indexing efficiency by the number of rounds is I'm going to take a large N limit. And the market is going to evolve by matching the deficits and surpluses according to this matching technology. Okay. So the function G has a certain number of properties. So first, you cannot create matches without one side. It's constant returns to scale. It's symmetric, and you never have more matches than one side of the market. And it's monotonic in the sides. Okay. And another key object.
Saki, clarify.
Yes.
What do you mean by symmetric here? Why would you impose that on a two-sided market?
We did it for simplicity, to simplify the math.
Does it actually help for anything?
I think so. Yeah, I think so.
If you're
So
generalizing it, your results will probably go through. I mean, in a
yes,
marriage
but it
market, it's
means
not crazy to have the
so
same measure of men and women, but in a labor market, what would it even mean to have the same measure of firms and workers?
okay. It
It's
it
not a big
allows
deal. I'm just curious.
it allows us to prove things only on one side. So when to describe properties based on only one side of the market. So when theta is greater than
Usually
one,
with constant
than one,
returns, all that matters is the tightness, right? The ratio. So it
yes,
doesn't really. Okay,
yes,
continue.
yes, yeah. All right. So tightness at a particular round is theta n, and you have the matching lowercase probabilities depending on the matching function. Okay. So
Okay,
the notion of equilibrium is
so
just that probabilities
Guido
and
has a question. So
yes.
the argument of the matching function is the number of traders or the positions?
Okay. So this is a great point, and this is a key assumption in this model. So what we're going to assume in the model is that each investor with a surplus S will split its trade into a per trader trade. So what we're saying is if there's an investor with $100 million in deficit, we're going to split that deficit into 100 units of 1 million, if that makes sense. So we're gonna fix an amount of transaction size, and we're gonna assume that there's many transactions of the same size, and the matching is per bit, per size, per actual size. I hope that makes sense. The reason why we're doing that is because then we're gonna take the number of traders to infinity, or that is the size of the trade to zero. And we're gonna do that precisely to get Gaston's question. So essentially, we're gonna say each trade, each bank that wants to trade, each investor that wants to trade, we're gonna take their overall position and split it into tiny bits. And the matching will happen by bit. So each investor has a portfolio, it has a position, and it's going to trade in small amounts, as if these were small trades for individual investors that belong to the same investor family.
So, Saki, basically, that all matches are going to be identical. There's a guy who is short one delta, another guy who is long one delta. But does it matter who give you the money? Because different
No.
banks may have
So
different.
it matters. It still matters as long as delta is a positive amount, but we take a small delta limit.
I see.
So what we say is in each round, a particular trader would match and trade an amount delta, and they would be trading, and they would be part of different institutions. So the surplus is for the deficit guy in the match depends on the equity of his financial institution. That's captured by J. But he's a small trader in the institution J, so he knows that whatever he pays is going to subtract from the equity of that institution. If he doesn't trade, he goes to the next round with that outside option. And the same thing for the lender. So even though there's a large family with many trades, the identities would still matter.
Right.
Even though you're doing the matches per size, they still matter unless delta is taken to a small number. And that's exactly what we do, borrowing from earlier work. So if you take delta to a very small number, the bargaining problem that originally has the identities of the traders here becomes exactly a bargaining problem where you factor out the marginal utilities. And this is exactly the same object you use as an approximation in your paper with Ricardo, if I remember correctly. So you guys use a Taylor expansion. We use a trick of small trade. But the key is that once these guys match, the only thing that determines rates in a particular round is the round itself, not the identities of the counterparts.
Saki, wouldn't it be easier and more micro-founded to propose a simple strategic bargaining outcome? Nash wasn't designed for this kind of model. You could do that, right?
Like Kalai?
No, not an axiomatic solution, but an extensive form Rubinstein or something. It matters in these models, and the micro foundations for Nash don't really fit your application well. You could do it, I think.
Okay.
Consider that.
Okay. Good.
The
I don't know.
simplest one is the point flip.
So what I would have to ask you is whether those alternatives also give you predictions for, say, for example, rate dispersion, which I'm
Yeah,
gonna
they would for sure.
Huh?
Yes, the answer is
Okay.
yes.
Okay. So then I'm really curious to know what you have in mind, but I'll ask you I'll ask you at the end of the talk.
Okay.
So here's the key. So because
sorry, another question
Yes.
from Guido. He asks Nash as the bargaining assumption. That is, trader takes as given the outcome of other traders operating simultaneously. So is that
absolutely you're using for this result, you're using a law of large numbers. Okay.
Right.
You make, you create an expectation of what these things are. Okay. So the result of this Nash bargaining is that you have these dynamic outside options, which are essentially, what is my outside option if I don't get to trading this round? That's the probability of trading in the next round. If I'm a lender, I would get the average rate. And if I don't get to match, I go to the following round and I would get that outside option. And as an outcome of the bargaining process, that's what you obtain as the average rate. So, this problem has this simple structure of a difference equation in the outside option for the two agents and an average rate. So, this is a simple corollary that says that the penalty rates that we use in the portfolio are just the time zero solutions to that difference equation, and the probabilities that we use at the very beginning are just the product of those probabilities. So how do we solve this model? It's actually very simple. So first I'm going to give you an algorithm, and then I'm going to give you a formula when you take a continuous time limit. So give me an initial tightness, theta 0. So that's how they start the balancing stage. If you can find out how theta evolves, because you know the matching function, I can give you the matching probabilities. You solve that forward, and you go backward in time to obtain the penalties. So it's a recursive algorithm. Forward in time to get the probabilities, backward in time to get the trades. And the time zero solutions are the objects of our king function. Okay. Now, here's where the magic happens. So take the number of rounds to infinity and take lambda n to 0. The problem for the market tightness becomes an ODE. That's something you guys know. I'm going to skip these pictures in the interest of time. Here's the key result. I don't need to know anything about what happens with trade within the period. We have the solutions for the time zero, actually for any time of the trade, for the overall outside options, and therefore for the average rate. And they're given by
Another question from Guido. He asks in which order you take the limits.
In which order we take in the order of the slides. So first the delta, the small trader size, then we take n to infinity while bringing down lambda at a particular rate. I hope that answers Guido's question. Okay. I'm skipping some plots regarding how the probabilities are moving, and because I think you all know Afonso and Lagos. But the key is that you obtain these kink slopes, the slopes of the kink function in closed form. They're almost a closed form in the entire model. What you need is a terminal value of that matching tightness. So if I tell you what the initial tightness is, so that comes from the portfolio, and I solve for a given matching function, the terminal condition, this is the value for the average value for patching a deficit. This is the average value for lending a surplus. They only depend on the initial tightness and the final tightness. Of course, each matching function has an effect on what the terminal tightness is. But all you need to know is what the initial one is, and give me the final one, and you know what the penalties are. The advantage of this is that if we are able to solve the ODE for tightness as a function of parameters, then all I need to know is what that value is. I replace it here, and I obtain a general formula to evaluate my convenience yields, and that teaches us something about how parameters affect penalties. So let me give you some properties. I'm going to go very quickly. If the market starts balanced, then this becomes an environment with exogenous probabilities, and it's akin to having one round of trade. That's kind of obvious. Symmetry implies that you can swap the identities, and if you swap the bargaining parameter, you obtain a rotation around the 45-degree line. And the third one is time dilation. So what time dilation tells you is if time has elapsed since the beginning of the trade, you can forget that time elapsed, start where you are in terms of the tightness, use this as your initial condition, and pretend that you're trading again, but with a different efficiency, with an efficiency that scales in the amount of time that has elapsed. So that's convenient to show general properties. So here are some other properties that should be very familiar. So one is, what is the effect of bargaining power on both sides? So of course, the higher eta, which is the bargaining power of the borrower, the lower will be the chi minus function, and the lower will be the chi plus function. Another property that should be very familiar to all of you is a Walrasian limit. So these are properties that we can show analytically. You take lambda to infinity, you recover a Walrasian limit. So what that means is that if the average tightness is above 1, the market converges to the outside option of the borrower, and otherwise it converges to the bargaining power. If there's a scarcity of borrowers, it converges to the outside option of lenders. And if the market is balanced, it so happens that it falls into the static. So it's not that it's not undetermined, but it's as in a Walrasian market, but it's actually determined. It falls at the bargaining of a static problem. Okay. So we can also ask the question, well, what's the role of the market tightness? So what happens if the market tightness increases? So if market tightness increases, of course, average OTC rates and the average slopes of those convenience yield function will increase because there's more scarcity. But what we find as a more interesting proposition, and this is something that came up to be important when we try to calibrate versions of this model, is what happens at extreme values. So what happens as theta goes to infinity? And you could conjecture and say, well, if theta goes to infinity, if theta goes to a large number, well, the value for the borrower has to go to the outside option, and that's actually true. It always goes to its outside option, but the value for lenders, the value which is the value of holding cash, even if there's a lot of deficit, doesn't necessarily go all the way to the outside option of the borrower. It really depends on the matching function, on whether the matching function um, has this limit or not. So if this limit is bounded or not. And that the reason why that property is important is because you could ask the question, well, the Federal Reserve has flooded the market with reserves. There's almost no guys with a deficit. So it's, remember, there's symmetry. So everything I say about theta going to infinity is also true about theta going to zero. So you could ask the question, well, is it true that there's still no risk for borrowers, even though theta, is going to zero when the Federal Reserve is flooding the federal funds market? And the answer, it depends on the matching function. So if the matching function has this exploding rate, then the answer is no. It doesn't. It doesn't matter. You will find a counterpart, but if it's not the case, then that's not true. So let me give you an example. So suppose we have a matching function of the CES class, and here I'm imposing concavity. So 0 is Cobb-Douglas, and say minus infinity is Leontief. So what happens, and these are different colors where I'm varying the elasticity of that matching function. What happens is that the blue here is Cobb-Douglas, and the gray here is the Leontief limit. So what happens with Cobb-Douglas is a rather specific property. So with Cobb-Douglas, this is the only matching function that satisfies the property of being less than or equal to 0. So it's only at 0 where you have this knife edge, where it can happen that the short side of the market, in this example, exhausts in finite time. So what we're trying to say is this is a market that is trading, but before you finish all the trading rounds, that once you move to continuous time are indexed by time, it can be exhausted. And whether the market exhausts in finite time or not depends on whether these both the kinks of the outside options or the convenience yield function go to the same value or not. And that's important to identify whether you have convenience yield despite having a large number of things like reserves, for example. So the properties behave rather differently in the Cobb-Douglas limit as in other matching functions. So you see, for other matching functions, they never touch the ceiling or the floor, regardless of how asymmetric the market is. Okay, so where do you get fully analytical cases? So by fully analytical, I mean the entire convenience yield function is a function of parameters. I don't have to put anything in a computer. There are a few cases where, as long as you can solve the ODE for tightness, you have a solution for the final terminal value for the tightness. Most formulas are really ugly for the ones we can solve, which are 3 or 4. But these two represent the whole spectrum of matching functions in the CES class, have nice these nice closed forms. So you can solve for the final tightness. So theta at 1 will be the finite tightness. So replace tau for 1 for these two extreme cases. Now, what's interesting about the Cobb-Douglas is that if this stop time in the bottom left of this 2 by 2 matrix happens to be less than 1, that means that trade vanishes in finite time. So you exhaust the short side of the market in finite time before the end of the rounds. For no other matching function, you obtain that. But you can obtain, you can replace that into our formulas, and you obtain, these pictures that allow us to compare what happens with our convenience yield coefficients and the average OTC rate, both for the Leontief and the Cobb-Douglas. And so you can see that the patterns are rather different. So on the one hand, the Leontief never touches the ceiling. In the Cobb-Douglas case, if there's a sufficiently imbalanced market, all rates go to the floor of the system, and the outside options go to the floor of the system, or vice versa. If tightness is super high, everything goes to the ceiling. And as I said, this is important because you could ask the question, how am I going to identify theta if there's many values for which you're actually at the floor? Or you could ask the question, for what level of tightness should I expect as rates to touch the outside option? So it really depends on the matching function. Okay, so let's go and talk about portfolio and very quickly about identification. So I think there was a question.
Yes, I think there's another question from Guido. So he writes, some of these results may be an artifact of the structure of time. Specifically, rounds are in discrete time. If trade happened in continuous time, the kink may disappear when funds are abundant.
So I didn't get that, because this is the continuous time solution. So this is the solution to the ODE in continuous time, and time in continuous time, the right exact moment where time vanishes is a formula. So it's not a function of discrete time. Maybe you have something else in mind, like a specific way of taking the limit. Maybe
But you said
could
discrete types, not discrete time.
Oh, types. Yes. Yeah, absolutely. We, we
That's
know
okay.
there are
There's a
other.
finite number of bankers, so it has to be discrete.
No, but Guido, I guess, has in mind that you could have a scenario where, you have fast bank trading banks and slow trading banks, and so you would have more. This wouldn't be an ODE, would be more a system of ODEs. So you wouldn't have like one outside option for the lender and the borrower. You would have one per type. Or if you had a continue, it would be a PDE. I suspect this T would be a surface more than what we have here, like a number. But I think it's still useful to learn this. We're not as uh, you know experts as you guys are on search and matching. So maybe some of these results resonate earlier results. Okay, so portfolio problems. So this is a standard problem with CRA utility. This is the problem that these guy solves. So he takes theta as given, he forms this guy, and he forms a portfolio to get returns into the future. And he solves the problem of portfolio weight as if he had 1 unit of equity. So if you have CRA utility, in fact, homothetic utility, the problem of forming a portfolio and determining asset prices scales with the amount of wealth that you have. So really you have to solve for the first order condition of one guy with 1 unit of wealth after paying consumption dividends. So you can forget about consumption saving if there's separability. And your first order condition here, once you take first order conditions with respect to M or any other asset, will give you a premium. On the left-hand side, you find a premium between asset I and the cash rate RM, which is risk-free. And it's a combination of 3 objects. The first object is a first order liquidity premium. That's on average what I'm going to pay or earn in the OTC market by holding more cash or buying more assets that expose me to settlement risk. That's in the first bracket. In the second bracket, what you obtain is an interaction between liquidity premia and risk premia. The third one is a conventional risk premia. So the third one is what you would always find with assets that are risky. The liquidity risk premia is telling you that not only, in models that want to think of liquidity premia and convenience yield, not only do you have to, or should you think of micro foundations, but you cannot decouple these things from risk premia. It's not like I will obtain a factor that I can call a risk factor and another factor that I can obtain called this a liquidity premia factor. They interact. Okay. So let me now go to identification. So, if we wanted to calibrate this model, and you wanted to say, well, what micro facts could I bring in from the OTC market, say for the federal funds market or for the LIBOR market or the repo market, to calibrate the objects in my model and make predictions, what objects would I want to identify? I would want to identify the efficiency, the bargaining power, the matching function itself, and maybe I want to identify how assets that induce different settlement risk map into convenient yield and to a tightness. So the problem for identification is having non-monotone predictions. So in this picture here, what we're showing you is how these coefficients of this kink function, chi-L and chi-plus, these outside options for the OTC market, vary in an example as a function of lambda. And this is a property, a proposition in the paper. So it turns out that it'll always be the case that one of the terms, either chi-L or chi-plus, depending on whether the market has tightness above 1 or below 1, that changes which one is non-monotone, but one of the two will always be non-monotone. So what's the logic? So in this example, what happens is that chi-plus is non-monotone as you make the market more efficient. And the reason why it's non-monotone is because you have always two opposing forces. As the market becomes more efficient, yes, you're more likely to trade, but the terms of trade may move against you. So the lesson for this is that because you have these two opposing forces, one of the sides, the side that is typically in more excess, will have a monotone value for holding cash. And when you translate it into the logic of convenience yields, it means that you cannot infer anything about efficiency from convenience yields. So if you say convenience yields are widening, I cannot tell you anything about efficiency. I can tell you something about other moments, for example, whether the market is more tight, but I cannot tell you something about efficiency. What allows you to identify efficiency is, for example, how much you borrow from the penalty source instead of the market. When you look at other moments, say, for example, how much you borrow from the penalty source, you can identify lambda. In this example, in this picture, we're showing you how much rates vary within the day, within a trading session as a function of theta. And in this example, which is for the Cobb-Douglas case, again, you don't have a monotone moment. It's flip sign at 0, and you furthermore have these flat regions that prevent you identification. So in the paper, we go into a discussion of what would allow us to identify moments. We say the overall relative volume of the OTC market vis-a-vis how much you borrow from the penalty rate allows you to identify lambda. Intraday dispersion can allow you to identify lambda or G. And if you look at, for example, the overall convenience yield, that allows you to identify theta. Okay. So, and we've used this in some exercises where we try to calibrate these objects, say with European data. The final thing, can I take like 5 more for the discussion?
Yes, there was a lot of discussion already, so let's go for another 5 minutes
okay,
for you
perfect.
to wrap up.
The last thing I want to discuss is efficiency in this market. Okay, so here we're going to show that portfolios are generally constraint efficient. I'm going to explain what's my notion of efficiency. But the sign of whether there's excess cash or an aggregate deficit of cash is undetermined. So sometimes the planner will want agents to hold more cash. Sometimes the planner will say you're holding too little cash, and there's two opposing forces. So, of course, our notion of efficiency depends on, what's lost in the aggregate, or what's whether you have insurance across agents or not, whether you want to have insurance across agents or not, whether you have risk aversion or not. So here, what we want to do is to say, let's think of a planner that takes whatever is borrowed from the penalty rate as a loss, as a deadweight loss. So, for example, if you think of Peruvian banks, are Peruvian banks holding enough cash in dollars vis-a-vis their international trade? You could think, well, if you want to minimize how much they borrow from the United States, you could ask the question, well, what would the planner do here? In the domestic context, in the context of the US, you could ask, well, if the discount window loans are not a deadweight loss, but they're actually rebated as transfer, well, that's not a loss. That is not a good model for that, or not a good planner for that. But if you think that borrowing from a discount window has some cost for the Fed as well, you could think that there's some deadweight loss associated, and that's the problem that we're studying here. Okay, so for this section on efficiency, we don't go full model, so we don't work with a full set of asset heterogeneity. We focus on a specific example that Javier and I developed earlier. So this is an example with only two assets, an asset B, which is loans, and D, which is deposits, and only deposits have settlement risk, and the third asset is reserves. So banks in this problem solve this portfolio problem with this kink function here. Okay, so we can show that if you take the first order condition with respect to cash and loans and you combine it, there's a nice representation of what is the convenience yield of loans B and cash M, and it's telling you that it's a weighted average of the probabilities of borrowing and lending in the OTC market, whether you're a borrower or a lender. Omega star represents the threshold shock that makes you a borrower. And these probabilities are twisted by risk premium. Okay, so you have to just give me the probability that you are a deficit guy and evaluate it on the right-hand side, applying your first order conditions, your portfolio weights, and obtaining chi plus and chi minus, and that gives you what would be the optimal M and D. Okay, but now what does the planner do different? So what the planner does different is that, unlike the market, it internalizes the market tightness. Okay, so it'll do exactly the same. It'll take exactly the same first order condition, but it will internalize that if it chooses more M or more D, then it affects the tightness, and that affects the probabilities via the exhaustion in the matching game of going to that penalty rate. And here's what you find. So if you take the first order condition for the planner, it takes the first line is exactly the first line as the market's first order condition. But then in turn, the planner internalizes that by changing the market tightness, it'll also change the slopes of those convenience yield coefficients. And it'll weigh each event by the marginal utility of being short or long of cash. A simpler case to study what forces are hidden behind this first order condition is a case when you take risk neutrality. So take risk neutrality so that the kink function no longer has risk aversion, and the planner's first order condition simplifies dramatically. So what you want is, and this is the third bullet point in this slide, is that the planner will want more cash relative to the market when what it internalizes as what is the effect of changing M on how much I borrow from this penalty rate is greater than what the planner does not internalize. So the market thinks that when it holds more cash, it's obtaining something that the planner says it's all a wash because you guys are all identical and you're all risk neutral, so you shouldn't consider this. That's the first term where it says private value of lending. So each guy thinks, oh, if I'm a borrower, I'm going to extract this extra surplus from by holding a little bit of cash from lenders. I'm gonna borrow less. And for lenders, it goes in the opposite direction. So that's what the planner would set to zero, that first term. What the planner does is it sees something that the market doesn't. It understands that by affecting the amount of cash, it affects tightness. And by affecting the tightness, it understands how overall, because it only cares about how much is borrowed from the penalty rate, how overall is changing that probability. So that's the reduction in borrowed funds. So when the reduction in borrowed funds is greater than the thing that the market shouldn't internalize, that's when the planner wants to hold more cash and vice versa. So you don't know which direction things go. So there are these we think are lessons for regulation. Okay, so of course you know what the problems are with it, or not problems, but you know what the drawbacks are with the paper. We make a lot of simplifying assumptions. Large number of traders, there's no network, there's no heterogeneity, there's no effort, there's only one layer. But I think still, like, the analytical tractability, at least for us, has been useful to understand several phenomena, and we think there are many other possible applications that have been studied with other assumptions. Like, for example, short-term puzzle. Why is like a 3-month rate, much more expensive than a 1-year rate if they're both risk-free? Why are otherwise safe assets have a premium? CIP deviations, these are risk-free assets. Take Dressler, Savov, and Schnabel. They assume, or they interpret their empirical findings as saying, there's market power in the market for deposits, but maybe there's an alternative story where large banks have a more stable funding, and that will show up in premia. And other people have looked at layered markets where the federal funds market is a market for settlement instruments for banks, but banks themselves are providing credit lines to non-banks, and that's the penalty rate for non-banks. And so that's what we think are relevant applications in multi-layered systems, payment system. I'm gonna end up there.
Great. Thanks a lot for a great talk, Saki. I think that was super interesting. We also had some good discussion already, and we have some more time. Let's go for like 10 more minutes for the Q&A. So the panelists can just ask questions as they did during the talk, but also the other participants can now use the Q&A function to ask questions. There's already one from there, actually, so let me just start with that one. So the question is, why do you choose Cobb-Douglas and CES as matching functions? Is this for modeling and analytical convenience, or for approximating observed data? And there's also a follow-up question whether you do point identification or partial identification to reflect empirical validation.
Okay, so first, the issues with Cobb-Douglas or Leontief are just an illustration. So this is just in this example. The properties that I showed you, for example, the non-monotonicity is a general property for all matching functions. Now, when I describe Leontief or Cobb-Douglas as examples, those are the only or one of the few examples where you can solve for the tightness in closed form. So you get the entire model for in closed form. So you just replace this object, the final market tightness, evaluated at time 1, which is the end of trade, and that gives you the convenience yield coefficients. The issue with this model is that you cannot get a closed form for tightness for every matching function, even within the CES class, because the ODE simply doesn't have a closed form.
Great. Then there's another question, or I think more of a comment from Guido, who says there could be an extra source of inefficiency if you would allow banks to either choose how many traders to send or how much each trader is allowed to trade.
Oh yeah, yeah. I have that question in mind for a long time. I haven't thought on how to crack the problem, but I think it would be super interesting to think of the optimal delta for risk management consideration. So set aside what's going on the OTC market. You could think of a scenario where a bank has to choose how many how big delta is. So on the one hand, the bank says, well, if I split my positions into different traders, that's great because I'm diversifying risk. But because if I have only one trader, you know, he may screw up the trade. So, but on the other hand, you know, they're taking other traders as given, so that's another inefficiency. So I've thought about related questions, but the moment you move away from these, nice deltas, then you struggle with combinatorials, and I haven't thought on how to uh, get around that problem.
Great. Okay, so now everyone else can ask their questions too.
Saki, Semi here.
Oh, hi, Semi.
Hi, good presentation. I have a question about the asset pricing implication part you presented. You derived this liquidity premium and the conventional risk premium. So
Yes.
here you derive these by introducing a separable type of preferences. Uh,
Yes.
Preferences on consumption and preferences on return on equity.
Yes.
But I feel like there is some type of double counting in there. Doesn't consumption already have the return on equity in that? So why do we need the second part exactly?
No, so this is exactly what you have in mind. Oh, wait a second. Why do you need the second part? I didn't
Uh,
get that.
con-
Sorry, Semi.
I mean, return on equity introduce risk into your consumption already, and consumption is inside the CRRA. Don't we have already the risk premium and everything through the first part? Why do we need the separable utility on return on equity?
Um, I see what you're saying. No, I mean, this is just to make an example where, gamma nicely appears there. But if you had margin, if I replace that RE to the minus gamma to marginal rates of consumption, then it would be equivalent. So I wouldn't need to have that formula. I don't need separable preferences.
I see. Then, for example, could we do like the more common thing in asset pricing, like use a recursive utility like Epstein's in, and
Yeah, we have
also,
a proof. We have a proof in our paper with Javier in Econometrica where we show aggregation with a kink function like this. So it's like this problem with Epstein's in, and
Mhm.
we show the results carry through. You would have an IES operator that's not part of this portfolio choice. So the right parameter is risk aversion. But then when you give me the value of this portfolio problem, that's like your risk-free rate in the portfolio where you choose in the problem where you choose consumption and saving. So you always have even with Epstein-Sinn, you have portfolio separation. So you solve the problem first of portfolios, giving a risk aversion operator that gives you a fictitious risk-free rate, and with that one you solve a consumption saving problem. So that property we showed that carries through even if you have a kink in the other paper.
I see. Thank you.
Saki, your results here with the convenience yield, depends on what the equilibrium theta is and whether or not there's like firms are like satiating themselves or not, right? Like, do you have some sort of restrictions on the distribution of omegas that sort of gives rise to there being a like a
No, you don't need any restrictions. So for example, if you have a scenario in this slide where for every shock, every bank has a surplus, maybe because they have a lot of cash or or the distribution of shocks is very, very concentrated for very low values, then all of those Chi-S terms would be zero. So the first line would wash out, and you would obtain a standard solution with the standard conventional risk premium.
right.
And you have a converse result where if everyone is going to be in deficit and there's no cash in the market to be lent out, those convenience yield terms would become just the discount window rate. And if you do the math, but it's a constant. So if you do the math, then it's like having the premium on the left equal conventional risk premium, but you replace RM for RW, I think.
So, but whether or not you get those two states must depend on if you have, like, say, bounded omegas or
No, I don't think so. I don't think so. You need some things that, because I don't think so, because we made every omega multiplicative. So I think you would have issues with if you make it additive, but because it's always proportional to the assets, then I don't think it's an issue. But maybe you have some pathology in mind that I didn't anticipate, but we've never encountered anything where we have to make more assumptions than this. And this is true. This formula is true for continuous or discrete distributions as well, because of Leibniz's rule.
So with the calibration, do you have a rough sense of what the magnitude of this, like, convenience yield is?
So in the papers we've written, so the typical issue that you find is that you need the penalty rates to be substantially large to rationalize convenience yields that you see in the data. So for example, if you want to look at the TED spread, or CIP deviations, you have to put a penalty rate that is typically very, very large, more than what the discount window rate is. Okay.
I would imagine that I was thinking that what you're capturing here is effectively, like, if you're trying to inform it just by the OTC market aspects, I would think that this should be downward biased relative to the overall convenience yield, because there would be the tail risk of their, like, if we're thinking about the Fed funds market, then there would be a tail risk that some bank isn't able to settle it at the
Yes. So absolutely.
that would blow up that.
Absolutely. In fact, this is a puzzle or a puzzle that a lot of people don't know, but it's like very salient. If you look at what happened with the Fed funds market from 1964 all the way to 2003, it always trades above the discount window. So in the lens of this model, that can never happen if literally RW is the discount window of the Fed. But go to the data, because it's quite remarkable. From 1964 all the way to 2003, the federal funds market was trading above the discount window rate until the Fed decided to change its operational tools.
So you haven't just
I'm telling you that the outside option has to be carefully calibrated. It's
Right.
not just the discount window rate.
Of course. But if you were just to do a restricted thing of not focusing on trying to hit the actual convenience yield that's out there, but just use, say, the Fed funds market or whatever the relevant one to try to pin down the convenience yield there. Are, have you done that, or would you be able to sort of, like, give, like, what the implied one would be there, and then sort of
Implied what? The discount window, you mean?
well, the convenience yield that
Oh,
comes,
no. Okay, so what we've been
the
doing in several papers is we look at convenience yields in the data. So say, for example, federal funds rate versus treasury rates, private loans, or say commercial paper versus federal funds or rate on reserves. We looked at convenience yields in international settings. And what we typically do is we infer parameters that allow us to rationalize those spreads. But as I said, you rationalize those with discount window rate data, with data on volume, and a few more moments. Typically, what you need is a very high penalty rate, more than you can rationalize just by looking at the Fed's website. But we typically match everything, and then use some other data moment to say, is this cross validation working or not? But yeah.
Okay, so let's maybe have one more question before we conclude the seminar, if there's any more pressing
Hi,
question.
I have one more question. This is Jane from
Hi,
Colombia.
Jane.
Very interesting talk, learned a ton. I'm curious, can you use the model to understand a bit more about the time variation in convenience yield we see, both in the long run trend and also the cyclical property of it? So your model can tell us a bit more about which component of these three we're looking at really contributes to the big change of convenience yields during crisis periods
Okay,
or
great.
over time?
Okay,
Thank you.
excellent. So what we've done exercises where we kill all risk premia. So we've never done that decomposition for the US market. In our exchange rate paper, we have an exogenous risk premium. We've done many versions. We work with exogenous risk premium components that allow us to rationalize exchange rates, and convenience yield terms that allow us to rationalize domestic convenience yield. So let me explain really quickly. So what we do is we say, what is the risk premium that you would need to explain a particular exchange rate at a particular date? And we look at domestic data, so comparing across currencies, so UIP or CIP deviations. And then within currencies, we say, what was the TED spread or the corporate bond versus reserve spread to obtain a pure liquidity premia that within one currency doesn't have risk premia across currencies. And typically it's of the order of 20%, 10% of the overall premia. So it's not the convenience yield, it's overall over the overall premium. So the first line is typically 10 to 20% in that exchange rate paper. So it's not that large. What we do find and what we say in the paper is that if you want to look at CIP deviations or UIP deviations, it's precisely when they're very large that this thing turns on and matters a lot. So for example, this typically turns on in 2008. And you know that because the federal funds rate, the TED spread, they're all like really widening in periods of crisis in the European sovereign debt crisis. So we say it doesn't explain a lot of the short-term volatility, but in large periods where there's a lot of scarcity of cash, these turns on. You have an estimation even with a Markov chain, and we say typically it's not very persistent, but you have these random bursts where there's a lot of scarcity of cash in the market.
Let's see. That's very cool. Thank you. I'll take a look at the paper.
Thank you. Thank you. Thank you, everyone.
Great. So yeah, thanks again, Saki, for a great presentation. And thanks to all the panelists and all the participants for the great questions. I think that was super informative. So as I said in the beginning, in the next few weeks, we'll send out the schedule for the spring term. So please stay tuned. There will be more SAMF seminars in the future. And thanks everyone for participating today, and hopefully see you for our next seminar in the spring.
Thank you everyone again, especially the organizers and discussants.